The U.S. government's credit worthiness was just downgraded. What does it mean for you, and how should you be positioning your investments? We'll discuss that on today's program, not just from an investment positioning perspective, but from a tax positioning perspective. Also coming up, we're going to give you a rundown of what all the key asset classes as well as the ETFs are doing. We'll take a look at this by industry sectors, and I'm also going to share with you a special treat, a way to organize your ETF trades, your investments, the things that you may be doing in your portfolio in a kind of an interesting way. I think that can help you to really organize your ETF trades. So let's get right to it, and let's take a look at some key charts that I have prepared for you, beginning with some of the key asset classes. As you can see from this chart, Bitcoin has been the runaway leader for all of 2023, gaining around 125% since the beginning of the year. Also, global stocks are ahead by about 11.5%. Ticker symbol VT is the ETF tracking that. And then we've got some of the other asset classes which have been just about flat performers or modestly down. Commodities up about 1%, SDCI, and then global real estate, REET, and bonds, BND, have been laggards. Now, in terms of looking at investment performance and what has really been leading the market over the past decade, if we look at this on a little bit more of a longer time scale, it's really been technology, and especially leveraged technology. We see TQQQ, which has gained just over 1,850% over the past 10 years. That's a 10-year annualized return of 35%. And over that time frame, the markets were trending up, and that has been a good thing for those using bullish leverage. That's the time to use it, is when markets are trending up. And for the most part, the past decade has been a market that has done that. Now, in terms of other areas, GBTC, which is a Bitcoin trust that's in the process of trying to convert to a spot Bitcoin ETF. It is held negotiations, or is in the midst of negotiations with the Securities Exchange Commission. And it's interesting that the SEC has been really very anti-crypto, but this is probably going to change. Bloomberg ETF analysts are estimating that we could see a spot Bitcoin ETF launched by January of 2024. They're saying there's a 90% chance of that. So that's something that we will definitely keep you on top of. And it certainly would be a bullish thing for cryptocurrencies in general, not just Bitcoin, but the others, Ethereum, Cardano, Solana, and the many others. This would really open a brand new area for ETF investors to participate. And then if you look at some of the unleveraged ETFs here, just the triple Qs and SPY, gaining over the past decade 198% and 401% respectively. Again, the emphasis on technology, AI, all of that with the triple Qs, that certainly has been beneficial. Growth has been an excellent area. This chart, by the way, or table, provided by our friend David Krensis over there at ETF Portfolio Management. Now, in terms of S&P 500 industry sectors, if we look at this, there's 11 industry groups within the S&P 500. And which ones are leading? Well, as you can see at the very top here, it's really XLK, XLC, and XLY, up between 25 all the way up to 45%. And these are the areas that have really led in 2023: consumer discretionary, communication services, and technology. And again, like I said earlier, a lot of this is being lifted by, of course, AI and the promise that it has. It's basically infecting and penetrating all aspects of our daily life, on our mobile devices, everywhere. How we order food, how we order coffee, how we drive our automobiles, transportation. AI is everywhere, and it's just going to get embedded even more in society. Some of the areas that have been lagging: XLU, really hurt by higher interest rates. That's a rate-sensitive sector. XLV and XLP, those have been the three weak spots. And we've got 6 industry groups up, 5 down. And that's sort of your industry sector rundown. Now, this is very exciting. I've been wanting to share this with you. This is something that I developed in my research over at ETF Guide. It's important to understand that no single investment strategy works all the time. And successful investors and traders must adapt to market conditions by using a variety of disciplined tactics. And so this is what I came up with at ETF Guide, and organizing our investing strategies into 4 general battle-proven categories. And these categories: number 1, contrarian; number 2, momentum; number 3, income; and the number 4, defensive. If I missed anything here, let me know, because we'll add it. But these are the real 4 areas that I think about in terms of like investing matrix, investing philosophies, 4 time-proven strategies. And, I can marry an investing great to each one of these areas. Like, for example, contrarian. I mean, the greatest investors of our generation, people like Warren Buffett and Charles Munger, are contrarians for the most part, value investors, right? And then you've got others that have made fortunes by being defensive investors. One comes to mind, I think, John Paulson during the financial crisis, the great financial crisis of 2008. He made his fortune, being defensive. And I think he heavily invested in gold. He was short in certain areas of the market that he felt were ready to collapse. That was, you could say it was aggressive, but it was also kind of a defensive move. And so my point here is, in terms of ETF trades, ETF investments, I'm going to show you in a next upcoming slide how we marry specific ETF ticker symbols to this particular matrix. But again, I'm going to, I think, start incorporating this into these weekend updates. And you let me know down in the comment section if this is helpful, if you like this investing matrix, and if you think that I should continue keeping it into these presentations. Now, it's important to understand that this framework that this investing matrix that I'm giving you fits into the framework that I teach you on this channel, which is 3 buckets within your overall portfolio. So you've got your core, your non-core, and then your margin of safety. Your margin of safety is, as you note in this slide, is not highlighted. So the battle-proven trading strategy, investing strategy, the 4 that I just showed you on the previous slide, only fit into the core or the non-core. That's where you could fit them into if you even wanted to utilize that. Has no business going into your margin of safety. Your margin of safety is something completely different. That is exclusively the anchor of your portfolio in terms of safety. It provides principal protection, guaranteed income, 0 volatility. It's the safest part of your portfolio. It keeps your investment portfolio anchored in times of instability, and it complements your core and your non-core portfolio because it does something completely different than those 2 buckets. So again, getting back to the contrarian, momentum, income, defensive, again, that fits into your core or non-core investment portfolio. So let's break this down in terms of your ETF strategy matrix. I didn't want to overwhelm you with too many ticker symbols, but I grouped this by these 4 categories: offense, defense, contrarian, and income. The one difference here, instead of momentum, we've replaced that with offense. Offense, I think, is synonymous with momentum because it's what's working now, right? It's momentum trades typically are ETFs or investments that are great performers, that are leading the market. They're rising in value. They're benefiting from that bullish market sentiment. And so often you'll see these types of ETFs or investments often trading near a fund's or a stock's 52-week high. And so compared to other strategies, this offensive or momentum strategy, the investments tend to blossom a little bit faster. You compare that with the contrarian investments. Typically, they're focused on ETFs or markets or stocks that are poor performers or out of favor or deeply undervalued. Often these types of trades or investments are executed when that fund or stock is trading near its 52-week low. And so compared to other types of investments, The contrarian trades often can take a little bit longer to blossom, but the prospective gains can be quite significant. And then, of course, income, that's pretty straightforward. Income focuses on ETFs or markets that offer high dividends. You can also apply this to non-dividend strategies that offer income, like selling covered calls. I have not included that in this particular matrix just yet, but in the future I may. And then you got your defensive trades, which tend to be focused on ETFs and investments that offer some level of capital protection when conditions are deteriorating or not good. And so this is just, again, a very simple way to think about, investments, grouping these different investments, whether it be stocks or ETFs, into these 4 different areas, and find out, again, which area works best for you. Generally, the offense tends to do well when markets are trending higher, and then typically you'll see underperformance when markets are trending higher. You'll see underperformance or lagging performance from some of these investments that are more defensive or contrarian. Whereas when market conditions change, markets are let's say, rocky, highly volatile, or trending lower, you'll start to see some of these contrarian investments and defensive investments really begin to produce some results. Now, another aspect of this week and update that I wanted to take time to do is focus on just one particular ETF within this matrix, because I think that would be helpful, is just to extract one ticker symbol, throw up a chart, or throw up a quick Ron explanation of what that ETF is all about, or my thoughts on that. And so I'm going to extract one from the income bucket here, and we're going to focus on PFLD, which is focused on preferred securities. And preferred securities are sort of this hybrid mix. They've got some aspects of equities, but some aspects of bonds, and it's kind of right in the middle. And it's an area that I think a lot of investors don't have exposure to. And PFLD has done a pretty good job over the past, this is a 3-year chart. If you take a look at it versus much larger, better known preferred securities ETFs, it's actually outperformed rather significantly its peers. It's also outperformed BND, which is a benchmark of U.S. bonds, a popular ETF that is in many investment portfolios. But PFLD has not just delivered an attractive yield, it's also delivered better performance versus its peers, better performance versus the bond market, and it's also delivered that with lower volatility. So we're going to talk a little bit more about PFLD in an upcoming episode of Spotlight, which should air this upcoming week on this channel, so be sure to watch for that. And those of you that may have been in some of these underperforming preferred security ETFs, or even individual preferred securities, maybe a time to maybe take a look at some tax loss harvesting if you own those investments in a taxable account. We'll discuss more of that on the upcoming episode of Spotlight. But PFLD, again, for the income investing matrix. Let's continue with another important topic. Moody's just cut the U.S. outlook from stable to negative for the U.S. government's credit rating. This is due to, and I'm going to quote here what they had to say, in the context of higher interest rates without effective fiscal policy measures to reduce government spending or increase revenues. The agency said that Moody expects that the U.S. fiscal deficits will remain very large, significantly weakening debt affordability. This is something that's not new to anybody that's a subscriber to ETF Guide TV or a viewer. We've been talking about this for a long time. Now, most of the YouTube community, most of the investment community, most of Wall Street is focused on this from an investment angle, right? They're saying, well, if U.S. debt is weak, or if there's a possible default, what's that going to mean from an investment perspective? What's that going to mean for the dollar? Currency crash. They're looking at this from an investment angle, and that's okay. That's okay. Nothing wrong with that. But don't miss the big picture of looking at this from a tax angle. What this means for taxes. U.S. income tax rates are going to skyrocket to pay for all of this. That's just a simple fact. I know it's not a very popular message, but it's one that you need to be aware of. It's one that you need to be prepared for. So we're not going to just talk about it. We're going to get you prepared for it. Stay tuned. This is something that the great Milt Friedman, my favorite economist, reminded us of years ago, talking about the incompetence of the federal government. It's not just incompetence, it's also imperfection and a lot of other hidden forces behind the scenes that we can't see that are causing all of this chaos. And so he had it right. He had it right that the federal government isn't very good at managing the Sahara Desert. They're not good at managing much of anything. And this is a chart that came from the Manhattan Institute that highlights the problem of rising interest rates and how that could push national debt towards 300% of GDP within a matter of 3 decades. Now, the other issue here that's not described in this chart is runaway cost and runaway spending tied to Social Security and Medicare, which is a much larger dollar figure and a much larger fiscal problem than national debt. So if you add national debt's about 33 trillion. Well, Social Security and Medicare are about 75, depending on the numbers that you're following, but 75 to 90 trillion dollars of unfunded obligations that the U.S. government's on the hook for. And so when you add all of that up together, you can see why Moody's is downgrading U.S. government debt, and of course all of the political gridlock and the infighting and the inability to get anything done. In terms of investment positioning and tax positioning, they're two different things. We already kind of covered what you should be doing from an investment perspective. Some of the things that you may want to do to protect your portfolio from a weakening government fiscal situation. Things like perhaps, Bitcoin, cryptocurrencies, perhaps even precious metals. That would be another way to do it. But from a tax positioning perspective, this is where a lot of investors get it wrong. And this is actually my latest book, Portfolio Architecture. There's 3 places your money can be from a tax perspective: your taxable bucket, tax-deferred bucket, and tax-free. As you can see, they're all lined up here side by side. It doesn't matter how much money you have or how much you don't have. These are the only 3 places your money can be located from a tax perspective. So you can see your taxable bucket. That includes things like your bank savings account, checking account, CDs, taxable brokerage accounts, cryptocurrency accounts. These are all investments where you're getting either a 1099, or if you sell that asset, you're going to have to pay a capital gain. So your ideal target for that particular bucket should be 6 months of emergency income. Now, that is your target. If you have more than that, then you're potentially exposing yourself to a tax inefficient situation. But again, this is a good target, 6 months of emergency income. Your tax deferred bucket includes things like your traditional IRA, 401k, 403b. You're deferring the taxes. You're not eliminating them. You're going to pay tax at some future point in time, and it's probably going to be a higher tax rate than today because U.S. income tax rates are going to be much higher in the future when you're retired than they are today. You heard it here first. Yes, I'm going to make that prediction, and it's a pretty safe prediction. It's one that I'm not alone on. There's much smarter people on this who agree with that the U.S. government is heading in this direction of skyrocketing U.S. income tax rates. And so when you've got most of your money in the taxable bucket and tax deferred bucket, you are 100% exposed to that craziness that's coming. And so that's why the tax-free bucket is so crucial. This is where most investors are either underinvested in or have zero investments. They don't have things like Roth IRA. They don't have things like Roth 401k. They don't have tools like cash value life insurance, which can be another place to put money that grows tax in a tax-free manner, and you can pull it out in a tax-free manner. So these are all tools that are available to you at your disposal. And so you've got an ideal target, as you can see here at the very bottom. Each of these 3 buckets has an ideal target. And if you've got, let's say, a 7-figure, high 6-figure, 7, 8-figure or beyond tax-deferred bucket, well, that's a problem because it's way above what the ideal target should be. And so what is the solution? What is the solution? Well, instead of waiting around and seeing what's going to happen with tax rates, are they going to go up? What's going to happen? And sitting on your hands and doing nothing, you should be taking advantage of today's historically low tax rates by repositioning money from the tax-deferred and taxable buckets into the tax-free. And that may be some combination of Roth IRA, Roth 401k contributions, or Roth conversions. If you don't qualify, you can still do Roth conversions, but these are things that you should be thinking about. These are things you should be planning for. 2023, we've only got another month to go. You should absolutely be, those of you with too much money in your tax-deferred bucket, you should absolutely be doing Roth conversions. I have no question that the math favors that in 99.9% of the situations that I've seen in terms of portfolio report cards that I've done, portfolio makeovers. That is just a simple fact. The math favors paying the taxes now when they're at 80-year lows and versus waiting in the future when they will be dramatically higher. So again, this is in my book, Portfolio Architecture. And I've got a link below, by the way. If you want to read the full ebook, you can download it in the description section below. Also, become an ETF Guide member. I've got a link below. You can join, and it doesn't cost anything. It's free. You'll get my weekly email notes as well as invitations to special events like our retirement webinars, as well as online courses and other training. So that does it for today's episode. I hope you've enjoyed it. We've talked about a lot of important topics, how to correctly position your money from a tax perspective. Don't think about what's going on with the U.S. government and the downgrade of their credit worthiness. Don't think about it just in terms of investment positioning and how to prepare for your investments for that, but think about it in terms of tax positioning, properly shielding yourself from the very real and serious threat of higher tax rates. It's coming, and you don't wait for it to strike and then all of a sudden try to plan for it. You start planning now. Tax rates here in the U.S. are going to remain stable until 2026, and there's no better time than now to take advantage of that by repositioning money into the tax-free zone. I'm also do another video about some changes to U.S. income taxes and tax rates coming for 2024. I'll do that in a separate video. Just don't have enough time to do it in this particular update. Thanks again for watching. I'm Ron DeLegge with ETF Guide TV. Be sure to subscribe to our channel. Hit the like button if you've been enjoying our content. And let me know what you think about some of the things that we discussed in today's episode in the comment section below. Thanks for watching. We'll see you next time.